so let's talk about that journey, right? Mm-hmm. How would you describe, just your first year, even having one, here's what I can tell, one, from meeting you, in person and having a conversation with you, but also from, hearing more about your story and in this setting, I can tell that you grew up with a very strong work ethic. You grew up with an example of that.
Yeah. You
embodied it. You took it. I mean, one that's really not common, to be frank, and it's not common, in the environment, especially, where we are now, because people want things easy, and they don't want to put necessarily that extra degree of work in. Wow. Tell me about your first year, like in the industry, like as soon as you got licensed, what was that first year like for you?
Oh man, you're going to laugh when you hear this. So when I first started the business, we had to complete a certain task, right? We get 3 business partners to come and start building up the brokerage. I did that in my first 7 days. They said it's supposed to take you 30. I did it in 7. I started going out campaigning immediately. I was so in love with the education that I had to be reminded, you need to get your license. So I was so caught up with the education piece, like, yo, you need to learn this. You got to meet my mentor. I was so in love with the education that I wasn't worried about the compensation. I was just in love with the mission. And then eventually someone said, you got to get your license. I said, all right, I got to go get this license. So I started studying. And Rod, it took me 6 months to get a license.
Wow.
I passed on my 13th try.
Wow.
Try. And there's times where I wanted to give up. There was times where people were doubted. And, I was married at the time to a particular lady. And she was like, what the hell? Might as well quit, because you're not making no money and everybody's making money off your team. And I had a big team, Rod. Big brokerage. I mean, I had over 60-something people in my organization.
Wow.
And I couldn't get my promotion. I couldn't get to the next level, right? But I was still in love with the mission. It didn't deteriorate my love to help people. So I continued. And when I finally got licensed, you're thinking, all right, he's going to hit it out of the gate now, right? No, I didn't. I didn't hit it out the gate right away. Because then some obstacles come up, right? Had a disagreement with the manager at the time, had to reshift, and guess what? We had to move to a different place and get my thing off. And I started from ground zero again. But once again, the setbacks didn't break me. It actually made me, because that setback was the setup for my greatest comeback. And I came back stronger and better because I learned throughout those 6 months that I didn't have my license. I learned about products. I learned how to train. I learned how to go out there and educate people. I just learned. So I took it as I paid, and I always tell people this, I paid $100,000 because that's what my mentor earned just from my organization, from coaching and mentorship. But I paid $100,000 for my education. So I tell people I got a PhD too in finance, because I learned from some of the greatest people. I learned about annuities when annuities wasn't a big thing. I learned about fixed index annuity when the GIUL was the thing in the market from Western Reserve. I learned about all of those IULs back then. And I fell in love with that whole infinite banking concept. And I learned about the book by Robert Nash. And I started reading that book. That's when I learned about the whole create your own bank from.
Yeah.
So I got so much knowledge in my first. So I tell people this, I would encourage any entrepreneur, look at your first year as your learning years. Learn as much as possible. Don't look at it like a day to make money. You can make money, but focus on how much you can learn and learn and earn too. But learn. And if you learn, you'll always go earn.
That's right. That's right. The more you learn, the more you earn, Hey, look, so let's go back for a minute. So for our listeners, because, someone here might hear, there's a buzzword that you mentioned, infinite banking. It's a buzzword right now. And the book by Robert Nash. What's the title of that book? So
it's called Be Your Own Bank.
Be Your Own Bank by Robert Nash. One, that's something that, if you're listening, you could go and check out. But if you could explain just in a quick synopsis, what is infinite banking? Like, what does that mean?
Infinite banking is pretty much finding a place or putting your money in a place where you get four things. You get growth, safety, protection, and my favorite, a whole lot of tax advantages. Because it's a place where you can put your money and get the growth where you get compounded interest, right? And we have access to places that you can get unlimited compound interest. You have the opportunity where some places they give you up to 10%. So it's the opportunity to get the growth or to get the compounded interest. Because you got to know the difference. The bank gives you simple interest. Insurance companies could give you compounded interest. Now, the safety feature is where even though your money is almost like it's tied or it gets credited by the stock market, right? The good thing is that it has a safety feature where every time the market goes down below zero, you never lose no money. So that's why the banks use it, because it's called bank-owned life insurance, BOLI. So the banks use it because they can't lose our money. So it has to have a safety. And then the tax advantage is where if we need our money, you get a tax-free withdrawals, or you can take a tax-free loan against your money, just like a regular bank. But the funny thing is that you're not paying the bank the interest, you're paying yourself. And that's a cool feature. And if God forbid something happens to you, your family get your cash value plus your death benefit free, tax-free, no estate tax. And it's because of the tax code 7702 section A that make your life insurance money and death benefit not consider an asset. But if you die and leave $1 million in the bank, that is considered an asset, which requires to go to a probate court if you don't have a trust in place. That's why we have to be our own bank.
Boom. Boom. Hey, look, why you talked about when infinite banking, you mentioned life insurance as a part of this. How come, and I know that you not only, talk to your clients about this, but you train other agents about these concepts. Like you help, people to start in their careers and kind of building their careers by learning this education and sharing it with others. Why isn't this something that is spoken about in your opinion, through the major news outlets or even in the school classes? Why is this not just commonplace?
Well, to get what they call controversial, right? Now think about this concept. If we was to learn about how to create our own banks, there wouldn't be no need for a bank. Then everybody go work directly with the insurance companies. And if we start working with the insurance companies and getting these compound interests and guarantee to never lose money, then there will be no need for Wall Street or what we call financial advisors. And if there's no need for a financial advisor, and then there's no need for someone to go work a job, but they just make money, save money, make money work for them, then they wouldn't have to work 40 hours a week. They may work, say, 20. That would mean that our economy will then drop down and the workforce will be depleted, or most people just become an entrepreneur. So if everybody's an entrepreneur and nobody wants to work, then it destroys our economy. So they have to make sure that only 1 to 5% has learned about this. And we even talking about this frankly, most people still goes over their head. Because we're so conditioned to believe that working a 9 to 5 will get us to the destination. But if one knows their FIN number, their final income number for retirement, where they know what they need for retirement and they know how much they need to save for retirement. And once they know their FIN number, that number will let you know that working a 9 to 5 job will never get you to the destination that you desire. So you have to settle for what the government give you. And 9 out of 10 times, what we have set up is where our Social Security be taxable because we're receiving money from a 401k or a mutual fund or a stock. But if we had our money coming from life insurance, we could reduce the taxation upon our Social Security. But that's for a whole nother topic.
Look, man, see, this is what it means to be a certified financial educator. So if you're listening to this and you enjoying hearing about the concepts that Keyon is sharing right now, this is why you should get a license. This is why you need to get to this industry. So you can start to learn some of these concepts, and then you can share them with the same degree of proficiency that he's speaking to them right now. You just mentioned, look, I was gonna save this one because, I've seen you speak about the FIN number. I've had the opportunity to share that information, with some other people, but I love the way that you explain it and talk about it. Could you give us a quick overview of what that FIN number means and how it breaks down? I know there's a whole example, but if you could kind of summarize it for us, just to kind of give an understanding to the people who are listening on the platform right now.
Absolutely. I'll even give them how simple it is to know your FIN number. The FIN number starts with three things. You got to know the now, the later, the end. That's how you write it down on a piece of paper. Now, later, the end, coming down in a vertical angle. After that, you got to know where you are now, your current age. So they said the average person starts saving for their retirement at age 30 years old. Later stands for your current your retirement age. They said that the average person want to retire at 65. And they said that the end stands for the average person that wants to die. Their life expectancy is around 85. So the average person thinks that $5,000 a month is enough during retirement, later years. So if it's $5,000 a month, that's $60,000 a year. So from 65 to 85, the average person would need about 20 years of money coming in, which is $60,000 a year. 20 times 60,000 gives you $1.2 million that the average person need to have saved up by 65 in order to receive $5,000 a month from 65 to 85. Now, what you got to do is calculate, well, I just figure out what I need. Well, how do you figure out how much you need to save? Take the need of the 1.2 million, add it to the now, divide it by the amount of years that you have to save. From 30 to 65, that's 35 years. So you divide 35 years into 1.2 million, it tells you that you have to save around $34,000+ a year. And if you divide that by 12, you figure out how much you need to save a month, which is about $2,800 plus a month. Which average 30-year-old can save $34,000+ a year in order to retire with $1.2 million at 65? So the average person see that working a 9 to 5 and putting their money in their 401k, they're selling for what's called a 40-40-40 plan, where you're going to work 40 years of your life, put your money in a 401k, and you're going to try to live off 40% of your income when you're already struggling with 100%. You're set up to fail from day one.
Powerful, man.